Hi, my name is Craig Martin. I'm doing this video for onmycourse.com, and I encourage you to please note the disclaimers contained at the start and the conclusion of the video. Information in topic 3.1 is from chapter 10 of the CAIA Alternative Investments textbook, which deals with natural resources and land. It is the start of topic 3, which deals with real assets, and we're going to basically just be looking at natural resources and land at this stage. You'll immediately appreciate why natural resources and land is an alternative investment. It's rather liquid, doesn't have any correlation to traditional investments like stocks and bonds. And so the overview of the learning outcomes for this lesson is to demonstrate knowledge of natural resources as well as a knowledge of land as an alternative investment. Thirdly, we will look in other videos at timber and timberland, farmland, etc., which all makes part of this first chapter, chapter 10. So the first learning outcome is to demonstrate knowledge of natural resources. The earth has things that occur naturally in it. They're called natural resources. They're natural, they exist in nature, they're the basis of life on earth. No human created them. But from a CAIA perspective, the curriculum looks at real assets, assets that have almost no human alteration. They come directly from above or under the ground. So this is the broad group of what you see here. Although the CAIA curriculum doesn't really look at livestock or animals as a natural resource, its focus is on farming as it relates to farmland and the agricultural crops on the land. And often it makes you see these natural resources from a point of view, a financial point of view, of almost having optionality. The purpose of the curriculum, CAIA differentiates between land in general, timber, timberland, agriculture and farmland. And in the next topic, we're also going to look at commodities, most of which are categorized as natural resources such as minerals, oils, etc. But some commodities may be processed or otherwise altered, and these are technically not considered to be natural resources, but nonetheless covered in the next chapter. And so what we want to do is we want to focus on some of the review questions that are at the back of the textbook in that particular chapter 10. And you'll see the first one is, what is a split estate and in what region are split estates uncommon? Well, in most jurisdictions, private land ownership is limited to surface rights, and the ownership of underground mineral and energy rights is retained by government. So a split estate is when the surface rights and the mineral rights are separately owned. Two different parties have ownership of the natural resources or the mineral rights on an estate. So one party can own the subterranean or the underground mineral rights, and the other party can own the mineral rights above the surface or simply land above the surface. And so in some countries the government owns all subterranean natural resources, possibly countries like China is a good example, and then they own these resources in totality unless they decide to grant them to a third party. Government of Russia also grants the rights to a small group of industrialists and bankers known as oligarchs, but by and large in countries like America, the private land ownership has typically included mineral rights, so much US land is publicly owned. Effective economic ownership of a natural resource is often accomplished through the purchase of leasing of the mineral rights rather than through transfer of recording property ownership. And so there are some opportunities for pure plays on natural resources through private partnerships or master listed partnerships. A pure play is an investment vehicle that offers direct exposure to all the risk and rewards or returns of a specific type of investment without the inclusion of other exposures. However, in practice, there are very few pure players, and most global natural resources are either owned by governments or leased to operating firms with mineral rights. You need to really understand this concept of split rights with real assets, as it doesn't only apply to natural resources. For example, you may subdivide a house or a building, perhaps the lower floors of different rights to the higher levels. You may obtain air rights, a right to build on the roof of a property, or increase the height of a building, or simply the rights to lease the roof for mobile or cell phone towers, etc. So that's slightly different, but something to be aware of. So keywords: split estate, when surface rights and mineral rights are separately owned, and pure play is an investment vehicle that offers direct exposure to the risks and returns of a specific type of investment without the inclusion of other exposures. So when valuing natural resources, especially mineral rights, you mainly view them as options to develop commodities and other real assets in the future. In other words, because they can be converted, they're viewed as exchange options. An essential element of natural resources as options is that the amount of money necessary to develop the resources is uncertain. So you can't really view them as a normal call option with a fixed strike price at a certain date. So let's assume that we have land, we know there's oil beneath it, and the value of the oil may be, say, $60 a barrel. But we know that Brent crude has reached $160 a barrel in the recent past, and it's been as low as $40 a barrel. And so the value when we finally extract the oil out of the ground is unknown. So we may be concerned about the variability or change in the output value. The cost of recovering or extracting the oil is also something that's variable. If oil goes up, presumably the cost of rigs and drills will go up as demand increases. So we need to be concerned about the variability of these input costs. How much are they going to change by? And so when valuing natural resources, we mainly view them as exchange options. And the key word we need to remember is an exchange option we can define as an option to exchange one risky asset for another, rather than to buy or sell one asset at a fixed exercise or strike price. So coming back to natural resources as an exchange option, the process of developing a resource has various variable and uncertain input costs. There's equipment cost, cost of drilling, fuel, mineral right cost, management, labor. All these input costs we refer to as the deliverables. In terms of the option pricing, the exercise price is represented by the deliverables. These input costs are both uncertain and stochastic. Stochastic just means that they're randomly distributed. They come whenever, they move around, they can't be calculated accurately. So keep in mind that technology advances and other factors can even reduce input costs substantially. Think of fracking costs, how they've come down. So we consider the volatility of these deliverables when pricing the option. This type of exchange option will have an exercise price, which we refer to as X, and a future value or payoff to be received by the option owner, which we annotate as S subscript T. Don't worry too much about the formula for the exam. This is just for explanation purposes. So the important thing to bear in mind is that not only are the input costs variable, but the price that the option owner will eventually receive for the commodities, the commodity price, such as oil in our example, is also uncertain or stochastic. The charts above show how volatile the oil price has been and can be. The market prices of both the receivables and the deliverables constantly change. So like all options, the value of the exchange option depends on volatility or on the vega. In the case of an exchange option, the volatility really depends on three things. And this is one of the review questions in the Chapter 10 book. The three factors that drive the underlying asset volatility used to price an exchange option. The first is obviously the volatility of the price of the asset being delivered. The more volatile the price of the asset being delivered, the higher the value of the option. The second thing that we look at is the volatility of the price of the assets being received. So the higher the degree of volatility, the higher the value of the option. So remember, options love vega, which is your measure of volatility in the option. Volatility indicates that something's going to happen. You're not exactly sure what, but the uncertainty increases the value of the option. And then finally, the third thing is the covariance or correlation coefficient between the deliverable costs and the receivables price. The higher the degree of correlation, the lower the value of the option. So you want them to move separately to be unpredictable. If the cost of development is highly correlated with the value of the commodity, the volatility of the value exchange will be lower and the value of the option will be lower, everything else being equal. So you want a valuable option. You don't want the deliverables and the receivable prices to be correlated. So those are the three factors: the volatility of the price of the asset being delivered, the volatility of the price of the assets being received, and the covariance or correlation coefficient between the prices. Let's consider question 3 at the back of the CAIA Alternative Investments textbook. It says, what is the name of an option with no expiration date? Would that option typically be a European option or an American option? Typically, an exploration of natural resources would be an option with no expiry date, as we don't know how long until we first find our commodities, and we don't always know the extent of the find. So we refer to this as a perpetual option. It's also an American option. American options can be exercised at any time, whereas European options can only be exercised at the end of the contract, at the strike date. So with natural resources being stochastic, you wouldn't be able to predict that date. So it's a perpetual option. And if you look at that, that's also an important keyword to remember. A perpetual option is an option with no expiration date. So we're still covering learning outcome 10.1 on demonstrating knowledge of natural resources. We are viewing natural resources developments as an exchange option, a perpetual American call option. So when do you exercise the option? Well, the answer to that question is that the option will only be exercised if it's in the money. In other words, the current value is greater than the exercise price. And this value can be expressed as a moneyness ratio, which we're going to go to into a moment. But let's quickly go through the concept of moneyness briefly. We speak of an option as being either out of the money, at the money, or in the money. These terms are very easy to understand. If it's out of the money, it's currently not profitable to develop. If it is at the money, it's essentially break even. So in the case of my oil example, if we thought that the oil price would move from $60 a barrel to 80 or 90, then the project is at the money now, but we may still decide to pursue it, as it could turn to in the money. In other words, it could have an intrinsic value and it could become profitable going forward. So the ratio or the moneyness of the option is the value to be received, the receivables, which we determine as X, over the cost of the option, the deliverables, which, as I said, we show as an S with a small t. There's no right or wrong time to exercise an in-the-money option, but the moneyness ratio is a good tool to determine how in the money the option is. The higher the ratio, the more valuable the option. We refer to such an option as being deep in the money. As a general rule, a natural resource should not be developed until the option is substantially in the money. So the moneyness of the option is really the ratio of the value you expect to receive over the cost of the deliverables. The numerator then in that equation is what you're going to receive, your commodity price, and the denominator is your input cost, the cost to extract the commodity. The difficulty with the perpetual option is that it continues forever. So even if the option is in the money, perhaps it would be better to wait before exercising it, as there may be a greater chance of making more money. The answer as to when is the correct time to mine a natural resource will also depend on the three things that we mentioned earlier, namely the volatility of the price, the volatility of the input costs, and the correlation between the two. Here's another factor to consider, namely the benefit to cost ratios in a natural resource development. We can take a quick example here of, say, a gold mine. And say there's one gold mine that's costs to extract an ounce of gold out of the ground is $1,050. It's a shallow, rich, concentrated deposit. It's in a country that's politically stable. There's easy accessibility and it's very close to a port. The other mine has a cost of $1,100 an ounce. It's an uncertain deposit with disputed ownership rights. It's in a country with government regulation and political instability, and it's far from any ports. So common sense would indicate that the first property is the one that should be developed, and this is what we refer to as low-hanging fruit. So the former mine offers far better opportunity when considering benefits or receivables over costs or deliverables. This is the low-hanging fruit principle, which states that the first action to be taken is the one that reaps the highest benefits over costs. Thus, the order in which natural resource properties are developed should be based on this principle. So why are some in-the-money options not exercised immediately? You can see from the example just discussed that both mines might have been in the money, but there are good reasons why some in-the-money options should not be exercised immediately. Some important keyword definitions just before we continue. Intrinsic option value is the greater of $0 and the value of an option if exercised immediately. The time value of an option is the excess of an option's price above its intrinsic value. You can look at this formula. The intrinsic value of the option is the maximum of the difference between the receivable value of the option and the cost or deliverable, or zero. Keeping in mind that the value of a long option is technically never going to be below zero. Why we say that? Well, we wouldn't want to exercise an option that was below zero. We'd simply walk away. Why would we want to make a loss? So we can express the intrinsic value as indicated above. The maximum between the difference between the current value and the exercise price, or otherwise stated as the difference between the receivables and the deliverables and zero. So remember, when valuing an exchange option, we also consider VEGA, the volatility in the receivables price and the volatility in the deliverables price, and that gets it to its intrinsic value. Then the next element is the time value of the option, which in options terminology is expressed by the Greek letter theta. This value comes about due to the additional value that time brings to the option. In other words, the longer the time to expiry, the greater the chance that the option has got to increase its value. Natural resource options normally have a long time before they need to be exercised. Options that are deep in the money will probably have a low time value and are likely to be exercised early. Options that are just in the money or out of the money may have a higher time value, and it will be advisable to wait before exercising these options. You can see from this chart that is labeled Exhibit 10.2 in the recommended textbook. It depicts a natural resource development as a call option with moneyness on the horizontal axis, representing different properties. The point at which a development option should be exercised is represented by point A. This is the point where the time value is zero. Above point A, the developer gains more wealth from immediately reaping the profit of development than from delaying the decision to exercise the option, and potentially benefit from the option's stochastic market prices. You will notice that the shape that the option takes on the chart, including its intrinsic value and time value, is convex. After point A, the option develops a negative time value. The final economics are similar to the decision to exercise an American put option early on. So we're going to look at some exam type questions here. First of all, consider an option in the market that has been priced on a natural resources development at $12.50 per ton. The current cost of the receivables per ton is $160, and the cost of the deliverables is $150 per ton. There's been very little volatility on these prices over the past 10 months. The option is a perpetual option. What value is most likely closest to the time value of the option? So you have 4 options to select from there. Another exam type question. The directors of a gold mine previously closed the shaft due to unprofitability when the gold price dropped to $1,000 per ounce. Gold can be mined from the shaft at a cost of $1,200 per ounce. The spot price of gold is now $1,300 an ounce. Allowing for a profit of $100 an ounce, what factors should the directors consider prior to reopening the shaft? And there are 4 options there.
Okay, so you got a feel for some exam type questions, and that's probably all that's going to be asked under the natural resources. We're now going to look at the land aspect of real assets, and there's a couple of keywords for you to remember. The first is land banking, and if you think about it, you're just putting the land away, it's banking it. So when an investor purchases vacant land now with the intention of developing or disposing of that land in the future, you're buying in advance of a specific need. The value of the land will depend on the location, obviously, but value can also be attributable to the possibility or option that the land can be developed, improved, or otherwise transformed into being productive. They will apply the low-hanging fruit principle and develop those that reap the highest benefits over costs. So land is characterized in 3 ways. If we think of vacant land, we call it paper lots. So it's vacant lots that have been zoned and have been approved for development by the local zoning authority, but for which construction of streets, utilities, and other infrastructure has not yet commenced. Blue top lots are lots where the development has already begun. It is the interim stage of lot completion, the grading of the property and the subdivision of lots have happened. They've already undercut the streets, there's been some interim drainage or civil work that has happened. The required fees have been paid. However, individual home builders or developers need to still acquire and pay for building permits. And then there are finished lots. So those are lots that are basically ready for occupancy. They have been constructed, all the development fees have been paid. Property inspection and building permit fees still need to be paid. But as you can imagine, it's all the infrastructure, but the individual homeowners will still obviously need to pay for their building permits. So that's what we call finished lots. As a review question, which you'll find at the back of chapter 10 of the CAIA Alternative Investments textbook. The question is, what is the name of the lot of land that is vacant and approved for development, but for which infrastructure construction has not commenced? Well, because it's still vacant, no construction's commenced, that would be a paper lot. So before we dig deeper, let's think of the concept of vacant land as an option. If you had undeveloped land, you would see it as an option on development. The value of the option will be dependent on where the land is located. If it's an area that's already well developed and it's the only piece of vacant land, it well may have a higher value than if it's one piece of much vacant land. Like we discussed with natural resources or land with mineral rights, the strike price of the option is on the cost of extracting the mineral rights or the deliverables. In the same manner, on vacant or undeveloped land, the strike price of the option is on the cost of developing the land. So obviously the risk for an investment in land is far greater than for a developed property for real estate. Why do we say that? Well, firstly, you don't know what the return on the development will be, and secondly, there's no cash flows to be received on the land. Nobody's paying you any rent. So when we value real estate, we can measure and discount the potential cash flows to try and value the land. The return on vacant land or land lots is dependent on certain probabilities. In other words, will the land be developed? If it is going to be developed, what are we going to build on it? What return will be generated? So there's a lot of unknowns. And as a result, land development tends to be riskier and more speculative than real estate investment. So again, we start thinking of land as an alternative investment in the terms of optionality. The key risks that are faced by land investors include the property type. The more uses that the land has, the more valuable it will be as an investment, as well as property location. The better the location of the land, the more valuable it is as an investment and the lower the risk. We will look at land as a call option on the development of the property. As with any other option, the key components are as follows. There's a strike price. The strike price in this case consists of all of the costs that are involved in developing the land. Expiry date. The time period is normally unlimited, so it's a perpetual option in which the investor has got a time to develop the land. The underlying asset is represented by the land as well as the improvements made to the land. And the payoff on the option is obviously the difference between the value of the completed product less the exercise price or the cost of development. Another key word to remember, binomial option pricing. This is a technique for pricing options that assumes that the price of the underlying asset can experience only a specified upward movement or downward movement during each period. Only two options. A keyword definition that you should also know is risk-neutral probability. And this means a probability that values assets correctly if everything else being equal, all market participants were risk-neutral. So review question 5. When and why are risk-neutral probabilities used? Risk-neutral probabilities are often used in derivative pricing models. A risk-neutral probability may be useful to price derivatives even when investors are risk-neutral, because the derivative pricing model is being calculated relative to the price of the underlying asset, and because the price of the underlying asset can often be viewed as already reflecting risk aversion. When looking to analyze the value of developing the land further, we can use the binomial options pricing model. This model considers both upward and downward moves, as well as the probability that the outcome will be an up move versus a down move. When working with probabilities, we can use the risk-neutral probability that assumes that investors are neutral towards the different levels of risk given a level of return. These risk-neutral probabilities are not necessarily the same as real-world probabilities. However, the risk-neutral probability does allow us to discount the future cash values at the risk-free rate. So we will consider the risk-neutral probability later, but let's consider a simple example when a probability is given just to illustrate the concept of the binomial option pricing model. A property developer is in two minds as to whether to develop a certain project. the following details relating to the project available. Firstly, we're going to just assume a 0% risk-free rate to make it easy. We paint a scenario of a strong economy where it's going to cost 600,000 US dollars to develop the value of the development, and it's going to be worth about 800,000 US dollars in the end. So there's a potential profit of 200,000 US dollars. The other scenario is in a weak economy with 500,000 development cost and a property value of 400,000. So the scenario isn't really feasible as the developer will lose 100,000. We can calculate the returns in a strong economy and the potential loss in a weak economy, but we need to know the probability of each scenario in order to be able to make a decision as to whether or not to take on the risk of developing. Now, we're not going to look at the probability, we're going to just be given it in this particular case. So we say it's going to be a 70% probability that the economy will be strong, which implies a 30% probability that it will be weak. If the economy is weak, well, we're simply just going to abandon the development. It wouldn't make sense to continue to develop and make a loss of 100,000, would it? However, the first step in evaluating whether it makes sense to consider the risk-neutral probability. So if we simplify this problem, the option price would be calculated by multiplying the potential profit by the up probability or the probability of a strong economy. As we would abandon development in a weak economy, we can simply add 0 to the assumption around the weak economy when pricing the option. So in this case, the option price of the value of the land would be worth 140,000. So that's on a 70% probability of an upside. The other option is to determine, well, what actually is the risk neutral probability? And here a formula is used where R is the risk-free rate, U represents the value in the event of an up move over the current value of the property, and D represents the value of the event in a down move over the current value of the land. In the previous example, we were given that there'd be a 70% chance of a strong economy. Now we want to simply calculate what the risk-neutral probability is. In other words, we're not giving a percentage probability. So firstly, we will assume that the current value of the land is 550,000 US dollars. In this example, we will assume a 5% risk-free rate. So we can start by getting the ratios of an up versus a down economy, and that comes to simply the positive, the up value 800,000 over the current value 550,000, which is a ratio of 1.45 in the up scenario. And in the down scenario, the value of the property is 400,000, the current value is 550,000, so the ratio is 0.73 in the down scenario. So in the numerator, we add 1 to the risk-free rate, which is 5%, and then subtract the down scenario. The purpose of this equation is to get to the risk-neutral probability. So having plugged in all the numbers, that comes to 44.4% recurring. In an exam scenario, because of limited time, this is probably what you'll be required to calculate. However, if you want to know what the option is worth, if the value of a down move is below 0, then the probability is actually irrelevant, as we simply won't exercise the option, just as we discussed before. But in a strong economic scenario, we assume that the cost of development is 600,000, leaving a profit of 200,000 US dollars. We presume a loss in the down economy scenario, so we don't value that part of the option, we keep it at 0. So in this case, the risk-free option price is 888,888 US dollars in total. So probably not likely that you'll need to take this extra step. This will be a typical exam question. An investor is considering options for improving an underdeveloped parcel of land and has determined that her construction cost and the eventual value of the property are highly dependent on future states of the economy. Assuming a strong economy, the land can be improved at an $80,000 construction cost, resulting in an improved property with a value of $130,000. In a weak economy, the construction costs would drop to $50,000, and the improved probability would have a value of $90,000. Comparable improved properties currently sell for $112,000. So what is the risk-neutral probability of a weak economy? Go on, use that formula that we looked at before, and see if you can answer this question. Okay, so let's consider the solution. The question is, what is the risk-neutral probability of a weak economy? So they're basically asking for the statistical probability that's been adjusted for so that it can be used to price a risky asset, in this case land development, if the economy is going to be weak. That is why we're looking for a percentage as an answer. Now the equation I looked at before takes you to that probability in a strong economy. Keep in mind, construction costs can sometimes be assumed to be the same in both a growing or a faltering economy. However, fixed construction costs increase the volatility of a spread, which in turn increases the value of an option. So although bricks and cement prices may largely be the same in a weak economy, usually construction costs will be lower because developers are prepared to make smaller margins to keep their staff occupied and their doors open. So coming back to the example, in this example, it will cost less to build in a weak economy. But remember, when determining the risk-neutral probability, we're only interested in what is the current value. So in this case, the current value was 112,000. And then we're going to look at the ratios in a strong and weak economy that were calculated before. Remember the formula I gave you? This isn't in your CAIA textbooks. Your CAIA textbooks uses a more complicated formula. You need to understand mathematics a bit better. But I really can't see how you can't manage with this formula. So you first of all calculate U, which is the ratio of the upside event over the current value. And then you calculate D, which is the ratio of the downside event over the current value. Then you plug the ratios into the formula, and we just assume a 0% risk-free rate. So 1 plus R, which is 0, so it stays at 1. There's the downside risk ratio, which we calculated at 0.8. Then in the denominator, it's simply U minus D, and you get the result of 55.5% recurring. Now this is calculating the risk-neutral probability, so the probability in a strong scenario. Now remember, if we go back to the question, it asks what is the risk-neutral probability of a weak economy. So don't fall into the trap of writing down answer C, 55%. It's rather answer B, because you're going to take 100 off the up probability, and that's where you get to the down probability. So if you understand my formula, and it's pretty logical, it's used in other finance teachings, you'll be fine. However, CAIA's textbook uses this formula here. The formula you'll find talks about the current value equals the expected value plus the down value times 1 minus the up probability. The expected value in the formula is the up value times the up probability. So if essentially you understand this formula and you're good with maths, then go on, use it. But for me, what I've demonstrated makes a lot more sense and will work for exam purposes. I think it'll get you there a lot quicker too. So on pages 233 and 234 of the CAIA Alternative Investments textbook, they use the same example, but on page 234 they assume that the construction costs are the same for both a strong and weak, or an up and down scenario. So let's see if we can get to the same answer as they're doing, calculating using our method. In this example, the construction costs are fixed, and as we said before, this increases the volatility of the spread, thus increasing the value of the option. Land values benefit from decreased correlation between construction cost and then potentially higher real estate values. And so in this particular example, the up payoff is 160,000. The construction costs stay the same at 86,667. The down payoff is a property value of 70,000, where the construction costs are the same, 86,667, and the current value of the property is 100,000. So the first point to understand with all of these binomial options is that we need to assume that we're under no obligation to develop the land if the down value is negative. Then we just simply abandon, we assume 0. We won't proceed with the construction. So in this case, if the cost of construction is 86,667 and you can only receive $70,000 in the down payoff, it would probably be abandoned because you'd make a 16,667 Rand loss. Now when we consider our calculation, remember we want to first of all look at the current value, which we said was 100,000. If we take the down option, that gives us a ratio of 0.7. In the up payoff, the ratio is 1.6. Step 3 to the calculation is to take 1 minus the down payoff, which comes to 0.3. Then step 4 in our calculation is to take the up payoff minus the down payoff, which gives us 0.9. Step 5 is then calculating the ratio, which we see comes to 1/3 or 33.333. Step 6 is then to calculate the value of the option, and that's pretty simple. We've done that before. So if you look right at the back of the September 2019 CAIA workbook on page 134, they refer to the top of page 234 of the Alt Investments textbook, and there you see they get the same method and they arrive at the same option value of 24,444, or rather I should say the same method that they use, but you need to have a little bit of mathematical gymnastics to understand it. So hopefully you find my method logical, it makes sense. If you have any questions, feel free to post them on our forum or drop me an email. That really covers the first learning outcomes as we start real asset investments, namely demonstrating knowledge of natural resources and of land.